Hey, good afternoon, everyone, and thanks for joining this week's live walkthrough and Q&A session. My name is Dan. I'm a senior customer success specialist here at Snap. Just some technical um, items on the list. There is a Q&A button within your window, so if there's any questions that you may have, uh, please do ask. And if we can't get to them by the end of the webinar today, I'll be sure to follow up with an email after the call. So before we jump in, to Snap itself, I thought this week's session could be on little tips and tricks that you may not be familiar with. And I just want to bring you over also to our Help Center. So the Help Center can be found beside your initials at the top right of your screen. There's a drop down that will bring you over to the Help Center. And this is where there's a vast amount of great information, whether it be webinars, videos, articles, tutorials, walking you through how to model various things within Snap. You can simply search for them. Anyone new, I would highly recommend that you start with the Start Here option. And again, great tutorials, great videos are available here. This is also where you can register for future walkthrough and Q&A sessions. What I do want to point out is our projections toolkit. So within here, again, some great information. We do offer short and long versions of a financial planning questionnaire, both in English and French. The short would just be personal assets, whereas the long has a corporation component to it in case your clients are incorporated. And if you go down, there's some checklists that you could use and sample reports. So when you actually go to build your report within Snap, you could always come back and reference one of these sample reports as well. So again, can't highlight it enough. It's a great resource available to you. And of course, if you can't find something, you can always give us a call at the number at the top of the screen here. Again, 9 a.m. to 6 p.m. Eastern Standard Time on weekdays. You can also email us at at support@snapprojections.com. And we are more than happy to help out. So let's jump back into Snap itself. So I'm going to focus primarily on the scenario setup and the planning pages. So here we're going to use our sample client, John Snapper. So I have John's information entered. If he has a spouse, we can enter it and include the spouse information here. For now, we're going to go with John himself. Now on the Generals tab here, we're entering obviously the retirement age for John and how long we want the projection to run. Now, when we get down to the inflation rates here, so these are recommended by FP Canada. You are more than welcome to update these to your preferences. And just like that, the rates of return are also recommendations made by FP Canada. My only note here would be these are gross. They are not net of fees. So depending on what you charge for planning or management fees, to take that into account for these defaults. And then once you've made your selections, if you have updated them and you want to use them on future plans, you can save them for new scenarios by simply going down to this defaults button and selecting the first option here, save current page settings for new scenarios. So you don't need to come back in here and update this every single time. I'll touch on expenses. So expenses, the base expenses here are reflecting what the client wants to spend in retirement. It's not what they currently think they're spending if they're not retired. So just keeping that in mind, and it is a net figure, net of tax figure that we want to include in here. And then, of course, you have the option to add additional expenses. So you could simply, well, let's do one for John. Let's add a vacation expense. You can enter the amount. We'll say it's going to be indexed to general inflation. And we're going to run that for John from the time he retires at age 65 until, let's say, 75. Now, we're not going to do it every year, but perhaps we're going to do it every 2 years. So you can change the frequency of that expense. And there we go. We have that additional expense now baked in, and that will appear on our planning pages in a moment. Going over to incomes. So we have John's employment income earning 100,000. We're not indexing that. We've labeled it as employment type. There's a few different options here. Taxable, RSP eligible, of course, and then SNAP by default will end that income in the year before retirement. So we have him retiring at age 65, and we have this income stopping at the end of the year in which he turned 64. Now you can add another income line. So for example, let's see, perhaps let's add a commission income. We're going to say he earns 20,000. We're going to leave it as other. We're going to say the commission's taxable. We'll say it's not RSP eligible. And let's assume that this commission income is just coming in the final years John is working. So I'm going to put from 63 to 64. And that will bring that income in as well. Now below this, if your clients have a defined benefit pension plan, this is where you would enter that information. So let's do one for John as well. So I'm going to add the pension, defined benefit. And there's a couple fields here. So you're going to notice before age 65 and from age 65. So if your client, for example, was to take their pension early before the age of 65, it may include a bridge benefit in the final amount. So you could enter that amount here. In John's case, we have him retiring at 65. So I'm going to leave that at 0. He's not going to receive a bridge benefit. But from 65, I'm going to put in a pension of 15,000, and I'm not going to index that. Now I'm going to select prorate yes. So what that is doing is it will be prorating it based on his date of birth. And while on that topic, you will notice around SNAP, there are these little question marks. So if there's anything that you're wondering what it means or what SNAP is looking for you to enter, just hovering over any of those will give you some more information, and that can be found throughout SNAP. So very helpful. Okay, so I'm going to go over now to his assets. So here you can see I've included all of John's assets. Just making sure the description that you're inputting is the actual type of account that you can select here, the value, and then from here, you're able to enter the portfolio mix. Again, these rates of return that you're seeing for cash, fixed income, and equity are the assumptions that have been made on this generals page. So I've assigned the asset mix, and then we have the final total weighted average based on that mix over here. Now, what I will say, you are able to reorder these pages or these accounts, I'm sorry, by using these arrows moving them up and down. And I will highlight why that may be important later on in the presentation, just making sure they're in the correct order because this is the order that they will appear on the planning pages. Now these sub-tabs I'll touch on quickly. So the TFSA tab, you're gonna go over and you'll notice TFSA contribution room for 2025. This is their lifetime amount. So if you have that information from, for example, a notice of assessment or Service Canada statement, you can update that full amount here. So I'm gonna do that for John. I'm gonna say he has 26,500 in room. Let's just correct that. That's a little high. And there we go. By default, it will just state the current annual maximum. But if you have that information, this is where you would update it. And the very same thing for the RSP. So again, by default, it will be using 18% of the client's income that you've input up to the annual maximum. But if you know their lifetime RRSP contribution room, again, this is where you would enter it. And then now that we have included an addition or a pension for John, his defined benefit plan, I have updated his pension adjustment. And again, that could be grabbed off of the client's NOA, and you can include that in here, and it will factor into his overall room. A couple other important pieces to note here is if we did have a spouse included, a younger spouse, you are able to select whether you want the RRIF minimums to be based on the younger spouse, and that can be done again under this RRIF subtab. And you're going to notice these conversion ages over here. So SNAP will want to convert in the very last year at age 71 so that client can start taking their income at age 72. However, based on your planning, if you want to bring in that registered income sooner, you could do so by entering new ages here. Just keeping in mind the conversion age is when the account is moved from RRSP to RRIF, and then the following year is when the income stream will begin. And then for the lira that we have entered, you are able to specify the jurisdiction for it. If you do not know what it is and you leave this just like this, not selected, it will base it on where the client resides. And in this case, it would assume Alberta. However, if you know that, you're able to select it here. And just like the RSPs, you do have the option of converting it from a lira to a LIF based on your planning and the age the client would like to take the funds out. And then once it's being converted, you do have the option based on the rules around the specific plan, whether you can unlock, for example, 50% and maybe transfer that into an RSP. We do have a subtab for the first home savings account. So again, this would be a spot where you'd come in and enter when it was open, contribution room, and the home that the savings plan is going towards. And then in employer matching, let's assume that this RSP here was a group RSP. You could come over here, select employment income. It will now unlock the employer and employee contributions, and you can specify a percentage being contributed to that plan. And again, that will now be reflected within the planning pages. So I'll do 5% and let's say 7% for employer contributions. So that's the financial assets. Down here, you can see real assets. So this is where you would enter the client's home, for example, which I've already done. So the house, the 550,000, the cost base doesn't really apply to a principal residence since there won't be any gain tax on it. We're going to appreciate at 2%. And here we're just assuming he already owns the home and we're not going to sell the home, and capital gains again does not apply. But let's just say that John wanted to buy a investment property. And we're going to say he's purchasing that at 650,000. Because it's at a future date, I'm just going to put the cost at 650,000. We're going to appreciate it at the same 2% that we're assuming above. And then the future purchase age. So we're going to say he's going to purchase that in his first year of retirement. So I'm going to enter that. And we're not going to assume he's going to sell it. We're going to assume he's going to keep that throughout his life. But then we are going to select capital gains tax on that. If he were to sell it, we would want to capture any gain tax on that property. Okay, so I'm going to go over to debts now. And I've already gone ahead and I've added the mortgage for his principal residence here. But let's add the mortgage for this new property. So I'm going to say it's the investment. I'm going to say it's a $400,000 mortgage, 3.99. Again, I'm going to tie it to when he's purchasing that investment property. So that was at age 65. And the assumed monthly payment, I'm going to be putting in as 2,150. And I will select that it's tax deductible. And again, if you're wondering what that means, you can go to one of these little question marks, and it just means the interest on the loan is tax deductible because of it being an investment property. And lastly, an important last step is just making sure the debt is linked to the investment property by selecting it in the drop-down here. Why that's important is if John went to actually sell the investment property, perhaps in a different scenario, and we did not have it linked, the debt would not be paid off. Now that we have it linked, when the house or condo is sold, it will also pay off the existing debt with the proceeds of the sale. Okay, just going over to government benefits. So by default, SNAP will assume that the clients are going to receive the national average, which you can see here is around 57%, and it lets you know that right there at age 65. However, if you have this information from your client, whether it be a Service Canada pension statement or they called in, you're more than welcome to update this. You can change the age in which they're going to be taking it, whether it be at 60, 65, or 70, the amount. And you also have the option to prorate it, just meaning that the income would start the month after the client's birthday. And then the indexing rate, this is again what we assumed at the beginning of the plan for CPP. And then finally, OAS. So OAS, we're going to default within SNAP to 100% of the benefit. But again, if your client perhaps hasn't lived in Canada all their lives, they may be only receiving a partial benefit. And this is where you could update that information and again, have the option to prorate that as well. Now, we do have an insurance and education component, but I do want to get over to the planning pages. So I'll just hop down to charitable donations. So by default, charitable donations will be unchecked. So to enable them, just check this off. You're able to enter any unclaimed donations from the previous 5 years here, and they'll be automatically allocated accordingly on the planning pages. And with that, let's hop over to the planning pages and take a look. Okay, so just starting at the top, the client, so this would be your client list or when you would go to add a new client. So very quickly, new client, here's my John Snapper. The client's name that you're currently working in, and then the name of the scenario that you're working in. This can be changed in a couple different areas. So you can simply just click on sample scenario and we'll call this John's first copy. And you can save it. And then you can notice that the name will change up there. You can also click on these three little lines and there is a rename option there as well. This little page I find very helpful. So this is where you can add your own personal notes about the plan, whether it's something to recall exactly what it was you were doing in the plan, the strategies being used in the plan, were there any follow-ups that you needed from your clients? This won't appear anywhere else in the plan, so it won't appear on the client report, for example. It's just for you. And I find that very helpful, especially when building multiple different scenarios. And you can just save and they'll keep those notes for you. Going back to the three little lines here, a big benefit I would say of Snap is you're able to copy scenarios. So if you have a base scenario built, but you want to make some tweaks or maybe some big changes, you do have the option to make a copy just by simply clicking on copy. And now you can see John's first copy and then in brackets copy. So we're now working in this new copied version. So maybe we're going to rename this. I'll get rid of this. And I'll call it John's second copy. And then to switch between scenarios, there's a couple different ways. You can click on the three little lines and hit switch scenario. And then we can go back to John's first copy, or you can simply just click on your client's name up here and you can switch that way as well. And what a really cool feature is if you've made two different copies and you say want to compare them, you do have that option. It'll bring up a window and you're able to see side by side exactly um, what the differences are in the plan. So for example, uh, total taxes payable through the life of the plan, OAS clawback during the life of the plan, just to provide you with a more clear picture on what might be the better plan to go with or recommend to your client. Okay, so now we're on the planning pages. You can see the items that we had added. So for example, the vacation running every other year up until age 75. We've put in that additional commission income for those 2 years, and we've added the pension as well. And then in regards to activating the charitable donations, you can now see there is a column for charitable donations. Now I want to discuss going over uh, what we refer to as pre-retirement years. So before cash flow management is turned on, which is indicated at retirement. By default, it will start here. You can move this up and down. But again, this is our cash flow management button and it will default to start at retirement. So let's talk about what's going on pre-retirement. So you're gonna notice our $70,000 base goal spending at retirement is 70. It's highlighted in blue, but these are all grayed out, so we can't change these. So just walking through exactly what is happening, it is taking any income of John's. He's paying his CPP and EI premiums. He's paying his total taxes for the year. And then any contributions that he would be making. So for example, those in that matching program that we specified. So he's contributing $5,000 now to that one RSP. We have no other savings entered as of right now. And then his current mortgage on the property, on his home. Now, when it comes to making contributions during the pre-retirement years, these do need to be entered manually unless you are doing the matching option, which is reflected here. But for example, you can see Snap's not going to automatically start making contributions before the cash flow management years begin. So in this case, I want to say that he is going to be making a contribution. So you just simply need to go to the individual's planning page. So right now, there's just one client. We're on John's, but if there was a spouse, there would be a combined view, a John view, and a spouse view. So you just want to be on the individual's planning page, and you simply go to the first zero. Once you see that pointing finger, let's do a click. Contributions are always entered as positive numbers. I'm going to say he's going to contribute $7,000 to his TFSA. We're going to copy that down to age 64. I want it to stop when he retires. I'm going to hit the check mark. And you can now see those cells are highlighted in yellow, which is indicating this is an override that you've input, so it's easy for you to see. The other thing you'll notice is the run scenario went from green to a yellow or orange, just indicating that this plan needs to be rerun and refreshed. Terrific. So now the plan is back in green mode. Those TFSA contributions have now been applied to that account. So again, after his income, his savings targets, his debt have been paid, his taxes, what is left over at the end of the year is indicated in gray here. And what Snap assumes is that will be spent money. So again, this isn't being saved, it's being spent. Now that we're in the first year of cash flow management and onward, this is where the tool will be doing the heavy lifting for you. In order to meet this $70,000 which in reality will be 79,296 spending goal, plus his vacation spending, and then taking into account any other income he's bringing in, which would be, for example, his pension, his government benefits. SNAP is figuring out what needs to come out of his financial assets to meet not just the 79,296 spending goal and the vacation, but also covering any debt payments that he may have. So if we go over, we can see there is a large withdrawal from the non-reg portfolio. Now that's going to help cover, again, his expenses and if you recall, he also was making a purchase of a property in that year, which is indicated here for 650,000. So that would be considered a part of the down payment on the condo. So a large chunk of money is coming out in the first year of retirement. And you can see that account is completely depleted in the next year. So you may be wondering why the non-reg is taking the money out first. So SNAP does have a default withdrawal order, and I can illustrate it for you. So if we go up here and we say show the CFM order column for this scenario, you're going to notice a new column appears. So paying attention to withdrawals, this is the default order within SNAP. So non-reg, tax-free savings, and RSP. So that's the order that the accounts would be drawn down in. So let's take a look. So the non-reg is depleted here. We can now see the tax-free savings money is now being depleted as well. And then once that is gone, now we can see that the RSP money is also coming in. So that can be changed. So for example, if you wanted to draw down the client's RSP first, maybe then the non-reg and save the tax-free money for the last, it would just be clicking on the first option here, finding your selection. So let's do this, copying it down. And then again, because we've made a change on the planning pages, we're just going to run the scenario again. And see the impact that that has on the plan. So you can now see here, the large withdrawals coming out of the RSP, those are depleted quite quickly. Afterwards, we're moving over to the non-reg. The non-reg is being drawn down. And then finally, the TFSA. Another option that I just wanted to illustrate here, and I hope I can make a good case for it, is you're going to notice the CFM method for this scenario. So the withdrawals are coming out on a proportional basis, meaning based on the asset size, the withdrawals will be larger. For the larger account, you can see a larger withdrawal versus the smaller account, a smaller withdrawal. So if you wanted to say draw down an account, and this is really only applicable when there's multiple of the same accounts, we can go sequential and let's see what that looks like. So you can see here, instead of sharing the expenses, it's going to completely deplete the first RSP before having to draw from the second RSP. And again, this only happens when there's multiple of the same account types. And it's also important to note why putting them in the right order makes sense. So whichever one is on the far left will be drawn down first versus the second RSP here. So again, it's just an additional way to be able to customize your withdrawals. You don't need to touch it, but that option is available to you. So in this case, based on John's level of spending, you're going to notice that there's this pink red blocks starting, which indicates a shortfall. And if we scroll over, all of his financial assets with the exception of the Lira account, just because the Lira has a maximum that can come out, so nothing above that can come out. All the other assets are completely depleted. So indicating a shortfall. So in order to fix that, you could go back into scenario setup or change it right here, the base expenses. So for example, we could go here and let's try 55,000. And I'll go back to the planning pages. So while that helped, we're still running into a shortfall position. So we do have what we refer to as recommendations, which is found up here. And within here, we can see that he's underfunded. He's only able to make 64% of his spending goal of the 55,000 currently. So there is a few options to paint a prettier picture for the plan. The most popular would be our sustainable spending. What this will do is generate a number that he could live off of for the life of the plan and have all of his assets depleted by the end of it without running into that shortfall. There's required savings, so this would indicate to him how much he would need to save on an annual basis leading up to retirement. This would only apply if he was in a overfunded state. How much money could he take out in the first year of retirement and still sustain his goal baseline spending target? And then this one would calculate based on the 55,000 we currently have in the plan, how much longer would he need to work and push out his retirement? So let's do sustainable spending as an example. And before we apply and run any of these, I always recommend that you make a copy, because once you calculate, apply and run these recommendations, your information will be lost. You won't be able to easily revert back to the original plan. So I'm going to make a copy. I'm going to calculate. Okay, and the answer right now is he could retire on 43,938 per year, which is 11,062 less than the current 55,000. So if we apply and run this, it's going to make a new copy of the plan. So we are now in the new copy under sustainable spending. And you can see that 43,938 it generated is now being applied to the plan. And there's no red. So by the very end of the projection, all the assets are completely depleted. There's one last withdrawal from the TFSA, leaving only 540. And that's what he would be able to realistically be able to spend during his retirement. Keeping in mind that sustainable spending will not touch any real assets. So it won't automatically sell any of the properties. It will just be depleting the financial assets. Now, what is also an option is you can run sustainable spending at different ages. So for example, if he wanted to spend, let's say, 65,000 for the first 5 years of retirement, so that would be 1, 2, 3, 4. Let's say 70. So we apply the new 65,000 down to 70. We'll run that scenario. Of course, we're going to see a shortfall later on in the plan. So let's run a new sustainable number starting at 71. So if we go back into recommendations and the blue number here, you can change that. We'll run it at 71, save, calculate. So now, starting at age 71, he can spend 36,000 and still have enough funds left over. to make it to the end of the projection at age 100. So we can now see the 65,000 for the first 5 years, and then the new sustainable spend number kicks in. So not a lot of planners and advisors realize that that can be changed. So it's definitely a nice feature. So I've kept you for a bit. There is a couple more things that I just want to highlight on that you may not be aware about. One would be in regards to hovering over, for example, the TFSA. So it will automatically calculate the TFSA contribution room, and just by highlighting the cell, you can see exactly what the contribution room is for that account. And just like TFSA, you can also do this for RSP. So for example, the contribution room available in any given year. And then let's go over to the LIF account, because that has a minimum and a maximum. So you can see what the minimum and maximum is for that account. And again, in any given year. So if you're confused by where did that number come from, you're able to find out quite easily. Now I know we went over a lot, but I'm going to let you go. I appreciate you for participating. I look forward to doing many more of these. And like I said, if there are any questions, please submit them, and I will follow up with you shortly after our call. But if there are no questions right now, again, I appreciate it, and I hope you have a nice afternoon. Take care.